Okay. Uh, Good afternoon, everybody. Welcome to the RBSA webinar on leadership conversations. Today's topic is going to be on special situations, and we have esteemed panel of investors and investor advisors to talk about their perspective. To take a step back and start with a basic definition, what is special situation? Special situation is, a textbook definition is an unusual event that triggers investors to buy an asset in an expectation of a price rise. So the good news is that while we talk about the COVID and everything, there is an expectation of price rise shared by the panel of investors we have. Typically, for the purpose of our discussion today, the stress businesses that we're going to talk about are not only the NPAs in the default cases, but we are also talking about businesses which could become inherently NPAs, businesses which show sign with high debt to EBITDA levels, low coverage ratios and stuff. So I think the discussion is going to be a very broad level discussion around how we define special situations. In terms of, if you see the global economy, many countries are going through a slowdown. And I think if you see the reasons of those, one of the key reasons is falling consumption in many places. Because of mismatch of low consumption and high capacity additions, you see capacity utilizations which have actually fallen. And because of lower economic and business activities, a lot of the businesses are defaulting, which has actually increased the NPAs, and therefore the credit supply has also got weakened. Now, if you really add that to the current crisis of COVID or pandemic, as people call it, even the good businesses which are strong otherwise have come into a lot of stress. The key reasons, as we all understand, are demand reduction again. I think all of us are whoring up to buying stuff which is essential rather than spending on luxury, which is essentially required to actually foment growth. Interruption of business operations is another key area. I mean, physically, practically, in many countries, it is not possible to hold business operations. And third is obviously because of this, there are huge amount of supply chain disruptions that are happening. So, that's kind of the global setting of what we see and why the whole pandemic and the crisis is kind of stemming, as a key concern. Now, if you take the context of India, the Indian slowdown, actually, COVID has hit it harder because we already had a banking system which was under stress. For almost last 5 to 7 years, we've seen a lot of cases. Cases such as ILFS, DHFL, Yes Bank have actually further added to the problem. I mean, as we know, whether it is banking, run on the banks and issues, it's always the perception of risk rather than just the actual risk, which also creates a lot of problem. It actually stems the loss of investor confidence and stuff. So I think cases such as ILFS have actually created a lot of stress in the economy. And, general overall reduction due to COVID. Even prior to that, I think we had issues relating to demonetization, GST, RERA. One can argue that in the midterm, I think these are good things to structurally improve the economy, the structure of the economy. But in the shorter run, India, as everybody knows, is a very strong cash economy, runs on almost a parallel manner. And if you actually have areas such as trying to regularize it through these initiatives, the economy would take a beating, and which is what we have seen. Now we are faced with a current banking scenario where the tier 1 capital of the banks is almost close to about 9-10%. The net NPAs 3-4%, gross are much higher, and I think the situation we see, particularly with the PSU banks, which are mandated by the government to actually put money into COVID-affected businesses, the different schemes that have been announced by the finance ministry. The banks are actually struggling with putting more money into COVID-affected businesses than actually be able to take up a bit more in terms of the stress side. Now, fraught with this lack of availability of banking credit and also shrinking of the capital markets, I think we see businesses increasingly looking for alternative means of finance. There comes the opportunity for special situation funds, credit funds, ARCs. And so does it really present, the situation presents a good opportunity for these funds? I think we will discover this with the esteemed panel that we have. And I'm extremely delighted to have 3 stalwarts in their own right in the India-Asia region representing Bain Capital, Mr. Kulkarni, and I'll give a profile of his in a bit. Mr. Amit Agarwal, who is actually with Edelweiss for a long time, previously with Arcil. And we have Weber, who's representing Cantor, which is a fairly large financial services firm, again looking at distressed debt in India. So coming to their more detailed introductions, Mr. Kulkarni, as many of you know around the panel and also in the audiences, he's a veteran banker, stress situation specialist, worked almost 36 years in the industry. He was previously the CGM of State Bank of India. One can say that he was probably the sole torchbearer in terms of the stress assets division of SBI. He did a lot of cases back then. He has moved to take the role of the CEO of the platform which is there between Bain Capital Credit and Piramal. The ARC is called the India Research and ARC. He's the CEO of that, and we are really honored to have you, Mr. Kulkarni. Welcome to this webinar. Moving on, Mr. Vaibhav Chadda, he's the MD of Cantor Fitzgerald. It's a very old financial services firm with a lot of prop capital to look at some kind of margin positions in their trades. He basically looks after the Asia business. He's based out of Hong Kong, and he's credited to have set up the Cantor's business close to about $1 billion into the India region. Through the various trades that he's been carrying out. Mr. Chadda was previously also working with Axis Bank in their corporate lending division, and prior to that he was with Blue Star. And last but not the least, Mr. Amit Agarwal, who's actually the senior EVP with Edelweiss. He's currently heading the stress fund, which is close to about $1.3 billion, of which about 750 is already deployed. He was previously with, involved as a founder with Edelweiss ERC. And some of their key partnerships, including the Canadian pension fund CDPQ, he was involved even in that in terms of creating a joint venture. So, it's really our pleasure, gentlemen, to have you here. Before we jump on to the actual questions, I just wanted to also introduce myself and my colleague. So I am basically Ajay, who lead investment banking for RBSA. With over about 24 years of experience. And I have the good fortune of working on both sides of the table. So I have spent almost 10 to 12 years working as a investor lender. I worked with a fairly large global DFI where I did a lot of growth capital. The same DFI is now very actively involved in creating distressed asset platforms, not only in India, but across the region. The firm is called International Finance Corporation World Bank. I also worked with 3 Big Fours, EY, KPMG, and Anderson. And currently I lead the firm investment banking for almost 3 years now. In terms of RBSA's investment banking strategy, just a quick 1 minute on that. So we are focused on 3 clear pods. We do a lot of disinvestment transactions. We have put in almost close to about $1 billion of Government of India disinvestment in the last 18 months. We are also working with a lot of private sector clients, and that's where we see a lot of opportunities of working with Cantor or with Amit's team or with Mr. Kulkarni, where again, we are looking at both on the growth side of financing as well as on the stress side of financing. So that's basically what RBSA and my own background. And in this conversation, I'm joined by Mr. Sachin Shah, who's our executive director. He leads our transaction services due diligence practice along with one of the other veterans in the industry. And he has worked with PwC in the past. He's also worked with Alvarez and Marsal, which is a leading restructuring firm till recently. And we have a good fortune to have him here. He's been engaged in looking at a lot of valuations, working on the due diligence side of businesses, and I think has a great experience of being involved on more than 250 transactions, including a lot of the stress transactions. And many of you in the panel and otherwise would also know Sachin. So, gentlemen, a very, very warm welcome to this webinar, and I welcome each one of you for this. Thank you very much. In terms of questions, I think I'll just quickly start with. If each of you could just spend some time to explain to us, what is your fund's focus or your business's focus in terms of the kind of instruments you handle. Is it purely debt? Is it debt and mezzanine and equity? What is a typical, ticket size that you look for? And in terms of I mean, I understand how the stress investing works, but also some clarity in terms of whether you go after more of debt and mezzanine versus taking equity positions. I mean, as we all know, special situation financiers are a step ahead of banks, where they actually participate a lot with the entities, and therefore by default they become more active players, whether through representation of debt or in terms of an equity control. Also, finally, if you could also explain a bit on your return expectations and how the entire mechanics of your investing works. So Avinashji, if I may ask, start with you, and maybe you could explain to us how your whole group works in their surgeon from ARC as well as the fund perspective, sir.
Yeah, thanks Ajay for introduction and having us on this panel. As you rightly mentioned, this India RF is a joint venture. It's a 50-50 joint venture between Bain Capital and Piramal. Piramal is an Indian conglomerate with interest in glass, pharma, financial services, real estate, and many such small businesses, other small businesses. They have grown by acquisition of more than 50 assets over a period of last 30 years, and they have done quite a lot of distress type of turnarounds also. And Bain, of course, is one of the largest distressed asset fund in the world. They have deployed more than $50 billion in distress space, and they bring in foreign expertise for us in terms of what they are going for. So this platform consists of two legs. One is ARC and another is the AIF. So put together, we call it a platform. And this, I think, is the model which recently is talked about in Buyer Bank or many such structures, so that we have flexibility to provide any type of capital to any industry in a most efficient manner. So that is the purpose for creation of the platform. Approach wise, generally we are fundamentally driven approach we take. Whatever businesses are good and can be turned around, we would like to get involved there. We would like to get involved in operation turnaround also, and would like to take majority positions in most of the time, where we have substantial say in the operational turnaround of the company. We generally invest in the range of around minimum of $50 million, and we participate in all sorts of opportunities. First our attempt was to buy a Binani cement, where Amit happened to be on the other side, so we were the buyers and they were the sellers. It created a history, but we lost out in that. And similarly, that time we had partnered with Dananya Cement for turning it around. And then we had also bid for Bhushan Steel, where we had partnered with JSW Steel. There also we lost competitive bidding process. But that was the approach where the assets are substantially large. Then we partnered with some good strategics to get some expertise in turning it around and to ensure that the whatever turnaround plan we are proposing gets. We also, wherever possible, we have done 2 transactions with the promoter offering OTS to the bank. We are actively engaged in that transaction and turning it for turnaround. We also have done 2 asset purchases in ARC. So basically, we provide almost all sorts of to any holistic solution to all the stakeholders who are involved in this system. So that in nutshell is what we do.
Sure, sir. Thank you so much. Moving on, Amit, if you could also light on your overall strategy. Edelweiss, as we know, is a huge conglomerate of debt platform across different pockets, and even people informed like me actually sometimes get confused in terms of what I'm doing. So it will be good for the audiences to understand specifically what you do. I think you have a plethora of almost 12 to 14 years with Edelweiss. So give us some sense of your kind of current role and also some overall sense in terms of how you participate in this side of business. Amit, I think you're not audible.
Hi, thank you, Ajay. I think let me give you a quick snapshot of what we do as Edelweiss, and then maybe an overview of what we do of the stress fund. So Edelweiss is essentially an alternative asset manager. We, in fact, are the largest asset manager locally, born and brought up. And to that extent, we have a private debt platform where we travel across 4 strategies, and we have raised significant funds in each of our strategies. How we define these 4 strategies is performing credit strategy, which acts only with companies of a certain market cap and above. but they are still stressed because of cash flows or value being there but cash flow not being there. So that's a performing credit strategy. Then we have a real estate strategy where we do real estate debt. Third is our infrastructure yield strategy. This is our latest strategy where we have now bought over, and that's a buyout strategy where we buy out running completed infrastructure assets. Here we have brought a transmission line, we've now bought roads, we bought some solar farm plants, and so that's a buyout strategy, but for completed infrastructure asset and focused on regular yield generation. And the oldest and one of the largest strategy for the platform is the stressed asset strategy. Under stressed asset strategy, we have an asset reconstruction company which manages close to $6.5 billion of stressed assets. And we have a $1.3 billion fund, which is currently in the process of getting deployed. And that's where we have deployed $750 million. So that's the four strategies which we do in the private debt, and I'm part of the distress asset strategy. On the distress asset strategy, just to give you a quick snapshot, I think what we have always focused on is only two vectors. So turnaround, and that's one of the key things which we look for in terms of strategy when we are investing in asset. One is either turnaround or B is the value buy. And I think we travel across both the strategies because sometimes turnaround is also a very time consuming and an effort making exercise, and you need to really make a significant investment for your return on efforts being high. So you really need to go after big turnaround strategies. And apart from that, we also keep on investing smaller amount of sums of money. And we range anywhere between 25 million to 150 million dollars in investment. So we have a bit of a larger ticket size bandwidth, and we are able to do that because we have an infrastructure in place and we have a lot of team members and we have support. And that's why we travel between the 25 million to 125 million dollar strategies. But I think turnaround, what we try and achieve, so there are two ways how we look at it, and very quickly, there is a liquidation value of a company, there is a going concern value of a company, and there is a strategic value of a company. So what, as a distressed investor, we always try to price the asset when we are buying as low and as close as possible to the liquidation value of the company. So when you're acquiring a debt, you basically buy anywhere between liquidation value and the going concern value of the company, because the company is not thought to be a going concern at the time that we are investing, because the bankers and the creditors of the company don't find it to be a going concern. So when you buy a company between that price, you make a margin when you make the company going concern. And that's let's say that's the first level of value addition and value creation that you intend to do. And then if potentially you can realize the strategic value of the company, then that's where your supernormal profits can come in. So your entry price and going concern value should give you your bread and butter profits, but any pricing above going concern which moves towards strategic value is what could be. And now that's a very well known case. For example, SR Steel was 17,000 crores of liquidation value, maybe 25-30,000 crore of going concern value, but a 40,000 crore strategic value. So the whole game and the whole continuum is between liquidation and a strategic value for those assets. So that's how we look at overall investing strategy.
Right, thanks for that. I just had one follow-on question on that. So, I think if you're investing into this, to realize, I've dealt with some of the Edelweiss platforms, and we understand that you do participate in income participating kind of structures. When you say that you've been buying in, if you could elaborate in terms of, would it be typically some kind of a combination between, say, distressed debt being bought out as a debt buyout, including some kind of share warrant purchase or a control, or if you could just elaborate. And then on debt side, what kind of return, or is it like a composite return between debt and the exit value over a period of time? Some clarity there, if you could also provide us, please.
No, so I think when I say buy-in, it could be anything. It could be, let's say, a debt buyout. It could be fresh financing to settle that asset. It could be a super senior structure to come into the play. And I think returns are always composite. I don't think we differentiate between debt returns and upside returns. But idea is to always make a mid-teen dollar returns. And I think that's where most of the global funds are. And I don't think that capital is available for India for stressed business globally outside of mid-teen returns. So I think that's where we try and end up being. And it's obviously a combination of debt and upside returns. And debt returns are always, almost always, a matter of fact, depending on the cash flows of the company. I don't think we look at anything else other than the cash flows of the company and what cash flows should service as a debt return. Because if we are not cash flow oriented, then we will have the same problems which are in a normal banking or an NBFC space, where you have defined payments, but the cash flows for those companies are not available to meet those cash flows. And I think Avinash has a great experience, and he sees it from both sides, how in a regulatory structure it's difficult to manage cash flows if the borrower underlying is unable to pay even for genuine reasons.
Sure. Thanks, Amit, for that elaboration. And last but not the least, again, Vaibhav, you've been a fairly active player. You've been a corporate banker in the past, so you've seen obviously good times with banking, and now you are obviously bringing in a lot of distress resolution. So if you could also explain to us how Cantor fits into how they view and how their set of investors that you bring in view Asia region in particular, and also India, the kind of trade book that you've developed, some ideas there. Also, ticket sizes. What is your current thought on the COVID crisis? Are you doing any trades? Some elaboration there also would help.
Yeah, thanks. Nice to be here. Without talking much about Cantor and keeping it to the point, so Cantor is a 75 years old financial services firm based out of US. 3 years back, Mr. Anshu Jain, the ex-co-head of Deutsche Bank, joined the firm as the global head. Being an Indian, he's very focused about building a business around India. So within Cantor, which is essentially a financial services firm with various businesses across investment banking and fixed income, we are trying to help our clients, which are mainly offshore asset managers, enter the Indian market and deploy capital around interesting situations. So we started a journey on the secondary side, where we have concluded about 23 secondary INR loan trades, and we have represented foreign asset managers for these secondary trades, where we've given the replacement capital to Indian banks from offshore. We've moved on from there, and we've started looking at private credits as well. Recently, we led a investment of $260 million to a Kolkata-based group just before COVID. Again, a structured debt kind of investment. But beyond that, one benefit that we bring to the Indian landscape is that beyond distress, the counterparty should see us as a solution provider across not just funding, but also M&A equity as well. We have a very large team of around 40 bankers focused on specifically power and infrastructure. So with the help of that team, which is active on a global basis in concluding M&A trades in these broad sectors, we are trying to now involve and find solutions specifically in those sectors in India. So we are involved in not just the kind of transactions that Avinash and Amit mentioned, but also in terms of buyouts of infra assets, where promoters might be looking for equity on to help with their other businesses. Thank you.
Thanks, Vaibhav. And talking about bankers, I mean, I think we are also on the same side. And as many of us are kind of growth bankers who've been involved in looking at either fresh financings or mature company financings, or we've been involved in terms of the sell side or disinvestments. I think in my little experience of handling stress investment banking is that, and that's my actually next question, a prelude to that. So the key issue that I see, which is there in stress investment banking and kind of making deals happen, is that you have basically three components or people involved. One is that you have banks, which basically are trying to reduce as much possible a discount on their debt. Then you have promoters who, depending on where they are, I think they would probably let go of control or not, depending on what the situation or what level of stress is there. And then you have funds and credit funds who basically obviously want to buy it, as Amit was talking about, as reduced valuation as possible, so that they can naturally have some kind of an upside at the time of entry itself. Now, this conundrum that I see between the three parties is actually causing a lot of blood and sweat on the street in terms of not being able to close the deals. And I think this has been my personal experience, or also RBSA and my other colleagues around the market. How do you see that resolving? I mean, I think, is there any and then this is a question to maybe Vaibhav, we can have maybe Amit. How do is there a real resolution to this in terms of trying to bring in deals and really make them happen? That's my first question. The second question is that when we see IBC, I think one of the reasons people do criticize IBC, but one of the success factors of IBC is that it brings, at least it reduces one variable, is the promoter being there, and therefore you are working under a process. And when there is a process and a defined goal, people try to kind of close deals, and it also acts as a deterrent to a lot of the promoters. Now, with the way suspension of IBC has happened, or generally, if you see promoters realizing that there is an outside IBC possibility under June 7 or any other, how do you see that issue also being resolved? Do we think that promoters difficult to come to a resolution for special situation funds? So that's broadly the sense of the question, that there is a lot of dichotomy in the process. What has been your kind of lesson learned? What magic do you wield in terms of trying to get these deals closed? The fact that you've done so many things. Weber.
Yeah, so look, I think I will just step back and answer this from a perspective of where things are right now globally. India entering into COVID was in a bad shape, predominantly because of the financial sector. And post-COVID, globally, there is a meltdown, and the investors in the distressed asset space have a lot of options of transactions to look at. So about a year back, they were struggling to find opportunities returning 10% dollar yield, and that's why everyone was looking at India. But now let's accept that there are options where people can make the same kind of returns in liquid instruments. And the Western economies have been a little bit more advanced to react, and a lot of corporates have raised cash at high cost debt just to make sure that they have enough liquidity to ride out the COVID situation in a stronger fashion. Unfortunately, what I find is that the acceptability of the market pricing among the banks in particular is lacking. I wouldn't specific bank officials. It's a systematic problem of recognizing the default only based on the historic value of an NPA. With passage of time, we mark it down. There is also troubles in terms of aggregating the debt. All the bankers in a situation don't think of it in the same way. So it's quite a challenging environment to invest in India. So which is why I think at the moment we have seen a bit of capital flight out of India. Investors have faded away from India for the time being. But to get back, we need to do a few things in order for that to happen. The first of all, you mentioned the pricing gap. Now, investors expect a certain when they invest into India, and one of the reasons for that is the legal system. 3 years back, when investors started buying Indian distressed paper with the anvil of the bankruptcy code, the expectation was that the IBC would be a fast mechanism to resolve corporate stress. 3 years fast forward, we moved ahead, but we've not lived up to the promise. The code has its problems. The time period to resolve is much longer than anticipated. So that's a major hindrance in order to bridge the gap, because as a buyer, the investor is thinking that I might take longer to resolve the situation, whereas the seller expects that the resolution is just 6 months away. So that gap is quite challenging, and I think the Indian banks will realize now that all through of last, the actual closure of transactions was quite limited because of the bid-ask gap. I'm hoping that post-COVID, the banks will bring down their offer levels. Time value of money is important. Even these assets underlying, if not resolved in a timely manner, their inherent value will diminish.
Sure. Thanks, Vaibhav. Before I move to Avinash ji, who obviously has a kind of a dual view about this, being a banker previously. Amit, the same question to you, with you being on the other side now and actively trying to look at good deals and good bargains. Anything that you would suggest, because you obviously sit on the credit side of things as well. Do you see it as a problem more from the inflexibility of the banks, or are the funds also becoming more lenient in terms of accepting and trying to solve the problem, because we need to see more trades on the block? So what is your view, Amit, on this issue and the challenge?
I think there are enough trades on the block, and I don't see, and again, it all depends on how you look at stressed and distressed funding. And effectively, there is still a lot of capital being deployed. In fact, India, and I've been in this market now for 15 straight years. I think every year the capital deployed across stressed assets, and you could deploy any capital. So seller could be a stressed seller. So like NBFC transactions that have happened in the market in the past, like DHFL selling off loans to Oaktree, and again similar transactions with Goldman Sachs, Piramal. So there are a lot of transactions which are happening in the stressed and distressed space, as you may call, and a lot of capital still getting deployed. I think in first 10 years of my career, we would have deployed maybe 500 million across board in India, and we would be deploying maybe a couple of $1 billion every year for the last 2 years as an overall stressed asset. So the market will grow, and sometimes the valuation gaps which are being pointed out here do exist, but I think structural solutions to meet those valuation gaps are also coming in. So even the securitization trust, the new draft guidelines, how to get those assets sold, they will come into play incrementally. I think we are finding ways. So we are finding ways for figuring out what's the best way in which the price gaps could be covered. Because sometimes it's also people want to keep a lot of optionality with them, and there is an optionality when you sell a distressed asset. So you could potentially want to keep an equity sliver that, okay, I have sold, but how can I get an upside if supernormal returns are being made by some investors? So I think solutions will have to be found. There is no straight jacket. If we keep on saying that the bank should take haircut and investors should make 25% INR returns, I think those valuation gaps will remain in picture. Secondly, I think on an overall basis, the areas where the investment is going, and as again maybe Avinash would collaborate with me, but the core sector, in fact, core sector is where most of the distressed assets are there, because manufacturing does not get as much capital attracted to itself as maybe a consumer business or a services business. But manufacturing is also a key and the heart of a company, and they actually generate the profitability with which services are bought and goods are bought. So the large part of stressed and distressed asset focus is also around hard assets, heavy assets, infrastructure assets, and those are difficult to create in the Indian environment. And there are sellers who are willing to sell those assets. So I think the valuation gap exists, and the valuation gap exists because of difference in the cost of capital. I don't think that valuation gap is going away anywhere, and to think that it will just vanish is not correct. I think we'll have to continue to find solutions. Despite all this, we keep doing transactions like a thermal power asset, and I'm sure Babu is fairly aware of that, got sold, and it was a cash transaction. Similarly, there have been a lot of other cash transactions in steel companies and other companies where valuations have been bridged by one way or the other. So it's about effectively finding solutions for everyone's problem. And unlike Weber, we don't have many markets to go. So we have to deploy our capital in India. So we will keep on remaining focused in trying to find deals within India. And there will be multiple deals. And COVID will actually expand the deal space for the stressed and distressed fund. But having said that, when you have uncertainty on the revenue model of companies, it is very difficult to even make investing, because the valuation gap just widens, because you are unable to put up a growth number to the businesses that you are getting into and therefore the valuation gap will become more striking and evident, is what I think.
Sure. Thank you, Amit. I think it was quite a response. And Avinash ji, over to you. Given your both sides of the table experience of being a banker for a long time and now, possibly also bargaining with the same bankers, if you can also just respond to us in terms of any. I think Amit has responded quite well, but if you would like to add something from your dual experience.
Yeah, so I think I pretty much agree with what Amit is saying. That investors have to find a different way of dealing and find its own solution rather than waiting for banks to change. Because see, another aspect is this gap arises in perception of valuation. Like Amit initially mentioned that there is a distress value, there is a fair going concern value, and strategic value. He gave an example of SR. So no banker or no investor ever thought that SR will be sold at that point in time, but it had a value at that level at that particular point in time. So valuation is it's not a very straightforward method by which you can say that value of this asset is so and so. Value for everyone is different. So that is one aspect. Now, when you deal with bankers, see, promoter always believes his value is the highest because he has put in a lot of efforts and he genuinely believes it. It's not that he wants to cheat anyone, but he believes that. And similarly, for banks, the methodology of valuations are more governed by what regulator wants them to do. So, banker's value is value of asset less provision. That is his value. That is his book value. Anything below that is an additional loss to him, and therefore it is all that value which he perceives as a value is very different than what investor is prepared to offer. And investor also, financial investor would offer something different. Strategic investor can offer something different. If I have a portfolio in which is buying one asset adds on the strategic value to me or adds it is a backward integration from me, I can give a higher value. So valuation is a very difficult subject to agree on, and therefore this difference will always continue between what is required, what is not required. And therefore this challenge is likely to continue, and probably we'll have to find ways to work with that. So that is what I believe. Are the transactions happening? Yes, transactions are happening wherever there is a value. So basic underlying is business has to be fundamentally good. If a company which was started 7 years back as a small company, the entire technology has changed. So then there will be no buyer. Irrespective of the fact that company was at one time one of the largest player in that particular segment. So this type of realizations comes to the banks, and it are gradually coming to the bank, but they also have to manage their own partnership. So that is the whole thing. And one more aspect, if I can touch upon, is quite a lot of deals can happen if it is a bilateral transaction. In Indian banking context, that bilateral negotiation and bilateral transaction is not possible for various type of rules and regulations that they are offered. So that also is one of the inferences. Yeah, this is the issue. Overall, these are 3-4 issues by which this challenge is continuing and is likely to continue.
Thank you, Avinash. And I think you mentioned about good businesses. Even Amit mentioned about good businesses now becoming stressed and maybe under the purview. With that, I think I'll hand it over the baton to my colleague Sachin to talk a bit about quality businesses affected by COVID to talk about. So, Sachin, over to you, please.
Sure. Thanks, Ajay, and a warm welcome to Avinash, Vaibhav, and Amit. Gentlemen, during this ongoing times, like many strong companies with quality businesses and management have come under stress due to the ongoing crisis, as we see. And considering that uncertainty is involved, like during next 12 to 24 months at least, in terms of achieving the business plan, what would be your basis of evaluating investments, even shortlisting such companies, like where you would want to invest? And how would you kind of price the risks while valuing these companies? And Amit, you specifically mentioned that like stress, historically, like stress has more been with infra real estate kind of sectors. Do you see like in current situation, many companies in other categories getting more stressed, and therefore the it becomes more preferable vis-a-vis infra? Of course, infra and real estate continues. In fact, they are also impacted quite heavily. But yeah, there are some other sectors kind of which become more preferable during this current crisis.
to use someone else's words, I think uncertainty is the pivot of our estimation right now. And I think that is going to be a very important going forward, because whether the current uptick in demand is a pent-up demand, whether the job losses will be of a variety which will cause a whole lot of problem, or the monsoons will take away the pain because rural economy will do very well. I think these are all at this point of time just I would say estimations, which will depend on how the COVID situation pans out. We are still adding almost 13,000 people. Yesterday was the highest ever tally of 13,000 patients getting added
Right.
to India. So we are still in a very uncertain situation, and we'll have to see how this evolves. Just to give you some basic numbers, I think from all the portfolio companies across our debt platform, and we have got several of them, we see that the cement is back. I think cement is up to 80% of its normal capacity operating today. Large steel companies on the long side are back to 50-60% utilization. In fact, first time ever, India is exporting steel to China. And there is demand. The roads are back. We are seeing the traffic coming back to 55-60% levels on various roads. So we are seeing that the operating capabilities of the company, our own portfolio company, our pharma companies working 100% capacity utilization, paper companies working 70% utilization. So the capacity utilizations are back. I think what an important thing is to understand is that this opening up will have to happen, either opening up or remaining locked down, because this whole red, orange, green is also not allowing the supply chain to move very smoothly across the entire network. So, and plus the large cities of Bombay, Delhi, which are kind of distribution hubs, and a lot of large traders who buy from these manufacturing companies have their centers in Bombay and Delhi. Unless these large cities open up in some form and shape, it will remain subdued to that extent. So uncertainty of projections is definitely going to be there. I think it will be easier to model for infra assets, because you can always model how the roads will behave, how the power companies will behave, because power companies have not got shut. I think despite we thinking that power assets are not great assets, I think during the entire COVID, those assets have been operating at full capacity. And when the government gives the 90,000 crore back, they will have maybe hopefully generating companies will have their cash flows back. So estimation is very tough right now. Just to cut the story short, I think estimation is very tough now. Each business will have to be evaluated with much more care and diligence at this point of time. Our diligences and future estimations will become important. Pricing gaps for the medium term will rise. I think there will be, banks won't believe that a company which was worth 500 crore 3 months back, because COVID has come, has become worth 250 crores. I don't think no banker will ever believe that. So we will have to build all of those scenarios in, and maybe the right way to approach this is to go for companies which are more core sector oriented, and where you believe that the long-term growth story of India will drive those asset values up, and not go for mostly consumer-oriented stuff. I think that will be suffering a lot more. So companies which were not geared, unlike manufacturing companies, which were always the poorer kid, and they were always treated with a little bit of a more treatment, because they never got price to earnings ratio right. They always traded EV to EBITDA. They already have suffered. But the consumer companies, which were like trading 20 times earnings and 40 times earnings, I think there is more value destruction going to happen on the consumer side than on the core sector side. And as distressed asset investors, all of us are invested in some form or the other in the core sector. And that is not gone away. India will continue to grow, even if it has a 5% GDP or 6% GDP or 3% GDP, and we have a critical mass. We are set back by a couple of years overall, but I think we will come back.
Yeah. So yeah, thanks. So largely you're suggesting, of course, where there's some visibility like power infra. Otherwise, largely it's wait and watch, right?
It's a lot of the things like steel, power, roads, infra, chemicals, even auto ancillaries, pharma. There are a lot of sectors which are very, very.
Obviously, besides that, obviously they're not impacted.
You can't wish away those sectors. You cannot buy car, you cannot buy maybe jewelry for your wife for a couple of months, but I think the core sector you will keep on utilizing, power you will need every day, telecom you will need
That's
every day.
right. Correct. Avinash, as we discussed, transactions are far and between. But obviously, if there are some transactions which are happening, like what kind of challenges you anticipate in closing those transactions in this testing time? Obviously, valuation is one of the aspects one needs to agree at the offset. But obviously, besides that, like how difficult it is to close transactions in this challenging times?
Yeah, so this challenging times, I haven't seen many transactions happening except unless you have capabilities and abilities of Mukesh Bhai. So that is the only transaction that happened in last few months.
Right.
But these times are definitely extremely uncertain and very, very difficult to predict in a sense that industry wise also cement industry or the road or the stick industry or even any industry in one particular zone or one area may do well than the other. So there are a lot of supply constraints and people may not be cover all the things at all the place. And this is a type of demand also which is coming down. Supply also there is a bottleneck. So no country has handled this type of situation ever before. So it's a very unique situation where people have just to try and learn. It is not going to be, there is no manual for this that if you like, you just give supply money to the consumers and they will spend. It is not going to happen like. So everybody has to have his own learning curve and work on that. And probably the only way to go about it is we have to first see, like suppose there's an investment if I have to see. So the point is about 2 months back, the utilization was 40%, and now it has gone, was 25%, now it has gone to 60%. Still, as a promoter, I may not be able to pay the debt because unless I achieve a critical mass, I am a asset heavy industry, and if I am 70-75% of my capital utilization, I may not be able to generate it. So therefore, it's a very in a short span in which we are facing this 3-4 months of lockdown, etc. It is very difficult to depend on any trend there. It may not be a very conclusive trend, and it may even reverse after the lockdown is over or something different happens. So very typically different situation. So if all investor has to look at it here, he is more likely to wait and watch because he has to first see that this industry which is proposing to invest or the unit which is proposing to invest, whether it is able to survive and sustain the type of returns which digital investment is going to investor is looking for is definitely not going to be earned unless the growth is visible, and this growth is quite far in current situation. Most of the analysts and most of the economists believe that it will take at least 2 to 3 years for the companies to come back to 2019 level. So this is an estimate that also based on their own opinions and judgments. So we don't know. So that the point is, it is extremely difficult. So most of the people like would look for downside protection. That is where Amit is saying that this some of the manufacturing units which were not the flavor of the day few days back, people can look at it because there is some downside protection. There are some real assets available. So
Right.
that is how people will view at it. And obviously, some of the industries which are like, let's say, airline or tourism related industries, they are definitely going to take longer time to come back compared to some of these industries like hospital or Medicare or that type and pharmaceuticals. So those type of choices one will have to make based on their own expertise or their own understanding of the particular sector.
Yeah, agree, Avinash. So what would be your advice to your investors?
So look, we don't have the luxury of, at least me and my investors don't have the luxury of being in India and being able to touch and feel what's going on there. So with limited access, and as of now, the investors we are working with, for them the focus is just the larger listed companies, because it's hard to do diligence of businesses where without visiting them, without visiting their premises, factories, understanding directly, it's hard to underwrite. So as of now, the offshore guys are focused on the larger companies where there is a lot of data out there, where diligence is easier. And the second looks like us and Amit think alike. The focus is on the infrastructure side, where again you can easily predict the long-term cash flow and the value of business.
Right.
Yes, we need more people to fund distress consumer businesses.
I agree. Like on your sectors which you focus, which is power infra, there's better visibility with a lot of other sectors. Sure. Thanks. Avinash ji, as we see that IBC has been moderately successful, and like presently, of course, there is suspension which is applicable for 6 months at least from now. So, what's your view on the current suspension, and does it present a more attractive opportunity to fund like yours in terms of better bargains with the banks?
So let's go in two steps, like bargains and about suspension of IBC. So now IBC, I think many countries have done. That's what we understand, and there are various levels of suspension they have done. Now, as far as Indian context is concerned, IBC for a smaller assets, any which ways was not the most effective tool. And that banks also over a period of time have realized this, that it is not the ultimate thing that you file everything. So if you see pace of filing of IBC even before COVID by the banks has slightly come. There could be some assets which are no value and they have to proceed to do it. But they were not seriously looking at IBC as an only option earlier also. Secondly, about suspension, it has anyway come after say 26th of June, 26th of March or something. By that time, anyway, there is a moratorium. So I don't expect anything was going to become NPA in a hurry in next 6 to 9 months. So that suspension is not going to impact substantially. Third aspect is about that suspension. Maybe if at all something was to be done, it's a controversial thing. But nonetheless, in this type of situation, as all of us who are investors are going to find it extremely difficult to diligence an asset. If you allow promoter to be part of the process of resolution through IBC, then probably there could have been much more better results rather than sure suspension where you can't do anything. But it is a difficult call. It is due to promoter, which is not because of promoter, etc. So it's unlikely to happen, but that is one of the things that could happen. Whether new assets will come outside IBC, that is anybody's guess, because there is nothing is going to be NPA for next 6 to 9 months. That is one part. And unless it is NPA, banks don't take haircut. Unless you have a situation where you can take a promoter wants some priority funding and is able to give you some assets separately and charge to the bank. And if you are able to give that type of funding, only those opportunities are there. They were there even otherwise. Without IBC also, those opportunities. So IBC suspension, will it increase the flow outside, is a very, very debatable point in my point of view. Theoretically, yes, it should happen. But then unless there is some sort of haircut on the part of the banks, things do not happen that easily. Priority funding structures are not working very efficiently in India. And therefore, I don't see much flow only because of IBC suspension. That is a bit tricky at this point in time.
Amit,
I think IBC, the NCLT courts need to really clear off the backlog. Maybe
Yes,
the 6
exactly.
months they could utilize
Yeah,
to clean up the backlog of cases, and maybe they can also start with a clean slate after the whole suspension,
yes.
because ideally 6 months should be the entire time required for resolution. At least under the IBC, that's the first limit. And even if all the cases which are more than now almost 400 days plus, and I understand there are almost 2,700 cases standing today unresolved in NCLTs across 16 benches. Even if we are able to get those 2,700 cases brought down to 1,000 number, I think it will be a great achievement for the next 6 months. So I think it's a welcome respite. Personally, I feel this suspension is a welcome respite if the courts actually focus on delivering the past cases, because as Avinash rightly said, there's nothing that's new that's going to happen in these months, and it's not like we will be suddenly throwing all the other companies back into NCLT. And this will also give a chance to the banks to actually resolve with a lot of promoters who are genuinely in issues and who are willing to dilute their equity, are willing to get their capital at high cost to repay some of these banks, and potentially they could do transactions with them in these 6 months. I think it's a good opportunity for both banks and promoters to resolve over the next 6 months, and funds like us and Avinash, everyone's there to provide that sort of capital to take out some of these companies, and for NCLT courts to set their infrastructure right, there are no new two benches getting formed, maybe they can get populated, reduce the workload. And if we could just bring the admission time has gone from 14 days to, I think, slowly it will inch up to 14 months. Currently, it is at almost 6 to 9 months. If we could really bring that back closer to its original estimate of 14 days, I think that would be a great service that could get done to the IBC.
Amit, precisely right. Obviously, the infrastructure needed that break, and there were a lot of filing cases. But the current June 7 circular, do you think it requires some update to have some resolution outside the IBC framework?
June 7 is actually, it's a very clean circular. See, the problem is not of restructuring, the problem is of equity. Once you restructure, you have to provide, and you have to wait for 1 year to make them standard. See, the problem is we are always linking restructuring with the availability of equity in the bank. If the bank is very highly equity capitalized, they would not bother, because that restructuring is fairly flexible. You could do anything. It's as much flexibility as you have on a restructuring as you can get. The problem is of the provisioning which you take when you do restructuring, that is actually beneficial to the company. You can only do a restructuring which is beneficial to the lenders, which protects their provisioning requirement, which protects them. But company should be at the heart of the restructuring. I think the company which is to pay has to be at the heart of the restructuring for the restructuring to succeed. And I think that's where something will have to come up. But I think incrementally, not too many restructurings will happen. That's my personal view. I don't think there will be too many restructurings happening. There will be more settlements than restructurings, and restructurings will happen only in a case which are way too large, or maybe there's nobody to finance them. You end up doing restructuring, but otherwise there will not be too much of a restructuring. And I'll defer to Avinash for providing views on this, because he will know more on the subject.
No, absolutely agree that the June 7 circular is really a wonderful thing which has come up very clean and crisp and very clear. There is no confusion in whatever they are saying there. So that way, it's a very good step with that RBI has taken. One aspect, of course, Amit has very nicely put it that it has to be a company which should be heart of the restructuring. Currently, it is the provisioning which is the heart of the restructuring for the, that has to somewhere change. So that is one part. Another aspect about restructuring is it has to be in a very timely, fast manner. Now, what has happened is because of requirement of two that rating agencies ratings, that rating agencies are taking months together, and those two of them managing with them is a bit difficult. So that takes, rating is required. I am not saying external benchmark is not required. External benchmark is definitely very helpful in any type of restructuring. But I don't know how to curtail these times which rating agencies are taking in arriving at a decision. So that is one part which probably they can look at. But otherwise, restructuring, as long as provision is the main criteria, and doing that restructuring or NPA reduction is the main criteria for doing that restructuring, not many restructurings are happening. That's a fact.
Right. And as you also mentioned that not the banks are helped outside the IBC framework, and yeah, it's always messy in that sense.
Yeah.
Vaibhav, your views, please.
Yeah, look, I think the question started with the IBC moratorium. So, there is a good and bad to it. The good part is, you get time to clean up the previous situations. The other good perspective is that given the overall dramatic credit situation globally, the funds are finding better risk-reward ratio opportunities elsewhere. So, the US Fed has, of course, started buying even corporate bonds. So there has been a rally in the corporate credit bond levels also in recent times. So I think while people are busy with other markets and there isn't much happening in India from that perspective, it gives the time for people to digest trades in other markets. And then by the time the moratorium is lifted and then people are ready to do transactions, banks are ready to take a view, promoters are ready to borrow capital, the capital will again chase India. The funds will again look at situations here. So in that sense, that's one positive I can think of it. But from an IBC circular perspective, look, this whole action around India started when the new code came, and that was the basis for people to look at India in a big way. So currently, more than the deferment of the IBC, it's the issue that Amit pointed out, that look, we are taking too long to resolve situations. So we need to demonstrate by a few winning examples to the global markets that we have the ability to clear up so many cases in short period of time. Our current recovery levels are at somewhere more around 40%. And aside the bigger cases where there was a lot of limelight and therefore political pressure to clear those up, the mid-sized companies are just lying out there and they're not in the radar of anyone. So it need to, I don't know what needs, how it can be done, but it's legal infrastructure which will be the backbone to attract more capital in India.
Thanks, Vaibhav.
Thanks.
Sorry, Sachin, I'll just step in. I think we're close to the closure time. So I just have one quick question to the panel. And as Amit rightly pointed out, company should be the heart of restructuring. So Amit, it's to you, and then maybe Avinash ji can also his perspective. So, a lot of the stress businesses we see, well, there is element of stress because of, financial structure not being correct, but a lot of the issues around misleading of demands and adding capacity at the wrong time, and also, having issues on the operations has been one of the key areas where a lot of businesses have gone wrong. When you, as a financial sponsor, basically take over these either through by way of buying debt or having an equity control, how important in your view is the kind of sector knowledge of that particular business? Because a lot of stress funds I talk about, they proudly say that we are sector agnostic, but then the point is, when you want to really create a plan as a value creation plan, how important is the understanding of the operations of the business, of the sector? And then if that is the case, Amit, to start with you, how what kind of capabilities you have as a provider of funds, and do you necessarily do it internally? Do you hire specialist management, or do you work through consulting firms? I mean, if you can just give us some quick sense on that. And then Avinash ji, given his Bain Capital and Bain background, probably can also support that. So over to you, Amit.
I think it's a very long answer, so I'll try and keep it short. For us, I think it is important to estimate as financial investors, I think we can always estimate the sector viability, financial viability, and the business model of the company. I think that is clearly, as an analyst, and that is a very day in and day out job of a lot of analysts to assess the business viability, the sector, the overall dynamics, revenue dynamics, EBITDA dynamics of the business. I think that can be judged. The hard part is to run the company. Hard part is to be there on the ground, meet all the government officials, local labor, panchayats. That's the hard part. But in India, you have no dearth of resources, and that's what we have realized, that you can create operational teams, you can create management teams, and not to take anything away from my job, but manufacturing sector is not as well paid as financial services sector. So to get the right resources at the right pricing is definitely, I think you need a good leader in manufacturing companies, and if you can create a good leadership team, a lot of companies really come out well. So the idea is to create teams, work with teams, and turn around those companies. I don't think we can build capabilities of every business. Yes, we will build capabilities of underwriting business models, build capabilities around how to estimate future cash flows, what are the variables which we need to focus upon, bring cash flow monitoring, turnaround management, and where we will use firms like yours, Alvarez, EY, PwC to do a lot of cash flow monitoring and stuff. but the core is the management team of the company, which has to be very, very strong. So either the promoter plays the ball and works for your benefit and has a strong team under him, or you create a team there. So that's about it. And the funds will remain sector agnostic, but that won't mean that we will not have knowledge of sectors. I think there will be knowledge, but it will have to be, the groundwork has to be done by a management team. And I think Bain Piramal is definitely doing a great job of turning around. They are very, very focused on turnaround and operating businesses. So maybe Avinash could add some color to this.
Yeah, so
Sure.
as
Thanks.
I mentioned in my introduction also, that we do engage operationally also in order to, because we somehow believe that it is very important part to turn around the operations. So when we started the fund, obviously we didn't have any portfolio companies and we were beginning. So we basically were depending heavily on outside consultants and individuals who were experts in that particular sector. Whenever we invest, we make it a point and we have such contractual rights to somehow differentiate promoter from the professional management in extent to whatever extent possible. So in most of both the companies where we have invested, we actually have hired an independent CEO also to run the company. And then we hire best of the consulting or best of the individual experts in that particular sector and that particular area of that sector also, wherein we arrive at some sort of 10 or 15 levers which actually can increase the EBITDA from a given level to the other level. When we hire CEO, we discuss this business plan and such issues, and also from the same sector, we agree to the business plan and all of them work together. And we also hire companies or consultants for handholding the takeover by the CEO to an extent possible, so that there are no great surprises and shocks in whatever later on comes out after diligence in the company. But having all this outside type of a support, we also realize that if we have to build this case, we have to increase the company. We need some person who is operationally very strong. We have recently hired one very senior person with 30 years experience in 4 or 5 types of companies, sectors. At a CXO level, he was working, and we have hired him recently. And he will now be leading this whole, monitoring and turning around the company. Consultation with, he will be he will have, because of his knowledge, able to have discussions with the promoter one-on-one basis. And he will also be able to monitor the performance, and he will also have some mentorship in turning around the companies. Of course, cash management is the most important part, and I think for that, whatever you can do, we all are hiring outside agencies and trying to monitor it, very, very stringently. But in addition to cash management, we are also getting involved.
Thanks, Avinashji. Vaibhav, would you have some comments to add to your experiences as well on this?
Yeah, look, I think the people we work with, they like to have sector focus. We know funds who have partnered with onshore steel platforms to go and bid for steel stress assets. Some of our clients, they have onshore road experts, for example, to go and understand the road sector better, buy loans or road companies or resolve those companies. So like Amit said, there is a lot of expertise onshore available, but once there is a trade to be done, then these are large trades, so you can afford to have the right kind of teams in place, in order to maximize the value and make that asset a strategic asset.
Sure. Thanks. So unfortunately, gentlemen, I realized that we should have kept this almost 2 hours rather than 1, given each of you have such good knowledge of the area that we are discussing. So our apologies that we'll have to call it off in terms of closure of this. But just wanted to summarize, given that we have so many participants on this panel, I think what I'm really hearing is that it's a amongst the crisis, amongst suspension of IBC, businesses kind of being currently put on temporary halt. I think what is really coming out very positive, which is encouraging for us, for audiences, for the large part of people who are watching this, is that there is a lot of positivity I can see in your conversation. So one is obviously there is a good amount of funding available. There is liquidity by special situation funds and financiers like yourself. Second, I think the part is that India and a lot of emerging market is going to be sticking to core infrastructure in terms of development. And I think we are not yet reached a place where, a lot of consumer-led kind of interventions are needed. And therefore, I think, and even if you're talking about consumer, I think supply chain will manifest itself in a way that, things will happen through technology and through, other means. So I think that's really a positive sign that the financing activity and the business activity should continue. Third is, I think I hear that, COVID is seen as a almost like a thing which shall pass. I mean, and a lot of people are basically rejigging themselves in terms of their financing strategies. Even regulators are getting a time to actually think, breathe, and then come out with new ideas. On the sector side, again, I think we see that there is enough knowledge that all the investors have, or they are able to borrow it. And then finally, I think the positive lining is that as we go and do more and more in this sector in terms of special set investing, the expectations from various counterparties are adjusted, and the valuation mismatches, while expected to stay, will find their way to find resolution. So I think that's kind of my takeaway on an extremely positive note. I wanted to thank each one of you. Avinashji, thank you for being here, and Vaibhav, thank you for staying late in Hong Kong. And Sachin, thank you for co-moderating. So it was a great seminar. I think we are encouraged to kind of hold you in different slice of format at some later stage to seek more knowledge from you. I would also like to thank our audiences who patiently listened to a number of questions and number of very, very interesting responses. I think with that, thanking all of you and thanking the panel as well. We draw close to this. Thank you.
Thank you. Thanks.
Thank you.
Thank you.
Thank you.